Now we can choose the future contract that we want to trade. Over here we can find all the available future contracts. But first, let's go over what a future actually is. A future is basically a contract saying that we will buy or sell a specific asset at a set price at a specific time in the future. So for example, when we are trading a Bitcoin future, we are not really buying or selling Bitcoin itself like we would do in the spot market, but we are entering a contract saying that we will buy or sell Bitcoin in the future. So for example, when we go long on a Bitcoin future contract, we expect the price of Bitcoin to go up. So we enter a contract saying that we will buy Bitcoin at a later date, but at a price which is determined right now, which is usually close to the current Bitcoin price. So let's say we go long on a future contract for 1 Bitcoin at a price of $25,000 per Bitcoin. On the delivery date, which is when the future contract expires, we'll have to look at the Bitcoin price to see if we actually made a profit or if we've lost money. If at the delivery date Bitcoin is trading at $30,000 per Bitcoin, we've made $5,000 in profit because we have locked in the price of $25,000 per Bitcoin when we entered the futures contract. On the opposite side, if at the expiry date Bitcoin is trading only at $20,000 per Bitcoin, we have lost $5,000. Unlike in the spot market, future contracts also allow us to profit when assets are going down in value. So for example, if we expect the Bitcoin price to fall, we will go short on a future. So let's say the current Bitcoin price is $25,000 and we go short 1 Bitcoin. That means that we agree to sell 1 Bitcoin at $25,000 in the future. If Bitcoin actually falls to $20,000 until the delivery date, we'll make a $5,000 profit, and if Bitcoin rises to $30,000, we lose $5,000. So when trading futures, we are basically speculating if the price of an asset will go up or down. In practice, we don't actually need to wait until a future contract expires to get out of our position. If we want to close our long position, all we need to do is open a short position for the exact same amount, and that will cancel out our long position, getting us out of the trade. The profit or loss is equivalent to the difference in price when we open the long position and when we open the short position. And even though we might enter a future contract about buying or selling Bitcoin or any other underlying asset, in practice we don't actually need to buy or sell the asset itself. Instead, we can just use any available asset as collateral, also called margin, to fund our trade and pay up when we close our positions. On KuCoin, we have USDT-M futures and CoinM futures. USDT-M stands for US dollar tether margin futures, which means that these futures are settled in the US dollar stablecoin USDT, so we need to have USDT on balance to trade these futures. CoinM stands for coin margin futures and means that these futures are settled in coins, so we would need Bitcoin, Ethereum, Polkadot, or Ripple to trade these futures. Most people trade USDT-M futures because it does make sense to use a stablecoin as margin rather than an asset like Bitcoin or Ethereum, which fluctuates in price a lot. Also, there's a lot more contracts to choose from in the USDT-M future market. So let's look for a Bitcoin future contract by typing in BTC. Here we can see that we have 2 perpetual future contracts and 1 quarterly future contract. The quarterly future is the one that has a delivery date or expiry date, which is the date when our position would be automatically closed. So here it would be September 30th. The 2 first digits are the month and the last 2 digits are the day of when this future will expire. The perpetual futures, on the other hand, don't have a delivery date, meaning they will never expire and we can stay in our position until we manually close them. So we don't need to worry about our future expiring. On KuCoin, almost all future contracts are perpetual contracts. So let's go ahead and choose the USDT-M perpetual future contract for Bitcoin. Then here we can see the price that this future is currently trading at, which is the same price we can also find here in the order book or here at the top for the most recent trades. Usually the future price is very close to the current price of the underlying asset, which in this case is Bitcoin. Then what's special for the futures market is that we also have a mark price and an index price. The index price is the average Bitcoin price across multiple different exchanges, also outside of KuCoin. The mark price is then calculated from the index price and the funding basis, which we're going to look at in a moment. KuCoin uses the mark price as a basis for liquidations. Liquidation basically means that KuCoin will automatically close our position whenever the price moves too far against us. The reason why KuCoin doesn't use the actual last price to determine when a position should be liquidated is to avoid unnecessary liquidations whenever the market is highly volatile or is being manipulated. So the mark price represents a more fair price to determine when a position needs to be liquidated. Then we have the funding rate. This is specific to perpetual future contracts. Because these contracts don't have a delivery date to settle the contracts, exchanges use funding rates to ensure that future prices and index prices don't move too far away from each other. This is achieved by having traders with a long position pay traders with a short position, or the other way around, depending on if the funding rate is positive or negative. When the funding rate is positive, the price of the future contract is usually higher than the index price. In this case, traders who are long pay for short positions. When the funding rate is negative, then the short positions pay for long positions. On KuCoin, that happens every 8 hours, so 3 times a day. And here we can see a countdown of when the next funding will take place. So let's say trader A is currently in a long position worth 10,000 USDT and the funding rate is plus 0.01% when the countdown hits 0. In this case, the funding for trader A is 0.01% of 10,000 USDT, so 1 USDT. This funding of 1 USDT will then be paid from trader A to trader B, who holds a short position worth 10,000 USDT. When the funding rate is minus 0.01%, then trader B would have to pay 1 USDT to trader A. However, if we close our position before the funding settlement countdown hits 0, then we are not participating in this funding settlement. Now let's look at leverage. Leverage trading is one of the main reasons why people want to trade futures in the first place. Using leverage simply means we are able to exaggerate our profits, but also our losses. Here we can adjust the leverage for our trades. It goes from 1x all the way up to 100x, which is insanely high. So for example, let's say we choose a 10x leverage and the Bitcoin future is currently at $20,000 per Bitcoin. With a 10x leverage, we're able to buy approximately 10 times more than the amount we have in our futures wallet. So if we want to buy a future of 1 Bitcoin, it will only cost us around $2,000, so a tenth of the actual price. If we go totally crazy and choose a 100x leverage, we would only need to pay $200 for a future of 1 Bitcoin. If then our Bitcoin future goes up just 1%, we have already doubled our $200 investment. So you can see why using a high amount of leverage can seem quite attractive. However, on the other side, if Bitcoin goes down just 0.5%, we would get liquidated and lose our entire $200 investment. So at that point, even if the future goes back up, we are already liquidated and we can't make any profit from an increase in price. So as you can see, using high leverage can make a lot of profits fast, but will also wipe us out clean very, very quickly, especially in a volatile crypto market.